Hi, everyone, and thank you for listening to our session about today's equity landscape and also to hear about Wespath's perspective. I'm Karen Manczko, the Director of Institutional Relationships with Wespath, and I'm joined with my two colleagues, Frank Holsteen, the Managing Director of Investment Management, and Andrew Steedman, Associate for Public Equities. Thank you both for joining us. There's a lot of noise going on in the markets right now. Mainly driven by geopolitics, energy, inflation fears, just to really name a few. So kind of starting things off, Frank, at a high level, how is Wespath thinking about equities in today's market?
It has indeed been a volatile end to the first quarter. You recall when we published our outlook at the beginning of the first quarter, we identified geopolitical risk as one of the things we were looking at and the potential for volatility. And unfortunately, we have certainly seen that with the Iran war and the volatility that came with it. And you're right, many economists and investors tend to think of it as noise, not knowing if it'll be short-term or long-term. Obviously, there's an incredible human impact that we don't look past. That sometimes is hard to fathom. But you're right that certainly there are significant shorter-term impacts. We're not sure how this will unfold. The closure of the Strait of Hormuz, the blockage of energy, and the inflationary impacts, certainly could push the global economy into a recession. But I also think there's the potential for longer-term, bigger picture impacts around the U.S. relationship with allies, relationships among the Gulf nations in the Middle East after the way Iran struck at neighbors. And so when there's significant change, when there is significant new information, our response is to go back to our investment philosophy, which really serves as the foundation, the bedrock for how we do things. And so I think about things like focusing on research and purposeful diversification. And so that's exactly what we're doing now. We're conducting that research and stress testing and whatnot.
Yeah, that was kind of my next question is, how does U.S. equities fit into our broader philosophy that we have at Wespath?
Certainly the philosophy of research and diversification isn't just across regions, it's also within U.S. equities themselves. And so during the first quarter, we actually saw quite a rotation in performance within U.S. markets, where the large tech companies really underperformed in the first quarter, and not surprisingly, energy and materials companies outperformed. Certainly, we saw appreciation in the U.S. dollar, which is a bit of a change over the past year. So, in March, the U.S. Was a little bit more resilient than international equities, but also in that outlook that we'd published at the beginning of the quarter, we identified deficits within the U.S. as an issue to watch, and a war is extremely expensive. Yep. I've heard over $1 billion a day. We talked about the Fed rate path, which under this revised inflation outlook is changing. Probably, the market thinks probably no rate cuts this year. And so there too, go back to our philosophy, conduct research, and be very purposeful.
Andrew, I know a lot of conversations we have with our institutional investors and even our institutional prospective investors is really around active versus passive across global equities. What does the latest research say about that?
Yeah, thanks for the question, Karen. Going back, as Frank mentioned several times, our investment philosophy, we specifically state that we want to thoughtfully blend active and passive management where it makes the most sense. So as an investment team, we have spent a lot of time researching this topic, discussing internally and debating among the group. Generally, we believe that active management is more effective when markets are less efficient, meaning that information is not quickly reflected in security prices. Markets are typically less efficient when there are less analyst coverage, less investors, and worse liquidity. So in U.S. equities, we believe that large caps are more effective for passive management, and we target active management in U.S. small and mid caps. And you see that in U.S. equity fund, where there's a larger allocation to passive management, a smaller, more targeted allocation to active management in U.S. small and mid caps. And we see that when we analyze historical manager returns as well among our managers and the broader universe, where it's easier for a manager to outperform the benchmark in less efficient markets like small and mid cap. Turning to international equities, research shows that those markets are less efficient, and there are more inefficiencies for active managers to take advantage of, and active management typically does better in international equities. We see that reflected in international equity fund, where there's a smaller allocation to passive and a larger allocation to active management, where we're specifically targeting passive through international equity index fund to large and mid-cap developed markets, which are slightly more efficient, and we have targeted active exposure in international small caps and emerging markets.
Yeah, that's interesting. I mean, and especially, to be kind of curious, and Frank, I'll direct this question to you, is obviously right now you highlighted there's some uncertainty. We maybe see some dispersion in the market because of this uncertainty, and we've even seen some of that kind of transpire in the last few months, especially in the month of March. Where does active management play? We know about inefficiencies and efficiencies, but when we have this heightened uncertainty, how do we view philosophically active management in a portfolio during this times like we're in right now?
In my mind, and in speaking with active managers, and my experience is when there's greater dispersion is when there's greater opportunity for the active management. The portfolio managers are scrutinizing company by company, stock by stock, and in periods where the market is just throwing money at the market, there's not a lot of investor scrutiny amongst names in the portfolio. And likewise, when they're making large withdrawals, kind of a broad brush paint stroke. And so when we get into these times when there's greater dispersion, there's really greater opportunity for the active managers, and eventually the rest of the market comes around to apply the same kind of discipline in evaluating the companies.
Yeah, so maybe there's like a name that they've been watching, but they viewed it as expensive. So when we see these dispersions, it likely creates opportunity for
Certainly
them.
can.
To do that. Yeah. So kind of on this equity asset manager, and Andrew, I'll kind of direct my question towards you. How do we think about, obviously we have managers in our portfolio that are more like broad-based, and then we have obviously more concentrated managers that may only hold, a hand, maybe like 10 or 20 names in their portfolio. How do we think about concentrated managers versus non-concentrated managers as it relates to portfolio construction in our equity funds?
Of course, Karen. We've spent a lot of time researching this question as well, going back to the philosophy where we want to make all of our decisions based on investment research. And we found that more concentrated managers that are more different from the benchmark are more likely to have a return that is more different from the benchmark, both positive or negative. However, we believe with our robust manager research and due diligence process that we're able to find those managers that are more likely to outperform the benchmark. That being said, we've recently leaned into these more concentrated managers in our equity funds, specifically within U.S. equity fund. We've invested in two managers, Axiom and Voss, which hold typically around 30 names, larger position sizes, and we would consider these opportunistic managers. On the other side of that, we maintain that we want to be properly diversified, and we don't want one manager or one return stream or one factor to really drive the performance of our funds. So with these concentrated managers, we're making sure that we complement them with managers that do different things so that we have a smoother return stream over a market cycle.
Yeah, and also, when I think about this, I also think about risk, right? Because you only want to focus on risk and concentration, but and return. So I often hear Frank, Jahara, and other leaders at Wespath talk about preference for idiosyncratic risk over factor risk. What does this mean conceptually, and why does it matter, and why should it matter to our viewers?
Sure. Well, conceptually, factors are characteristics that we can mathematically measure and model that different groups of stocks might have in common. a factor could be size, meaning the capitalization of the stock, or it could be value, the price to earnings ratio, and you can mathematically measure a stock's exposure to various factors. Mm-hmm. And if you end up with a portfolio with a heavy tilt toward a particular factor, that could be intentional or it could be unintentional. If you have active managers that are picking stocks and inadvertently give you a portfolio with an unintended factor exposure. So we are very careful to monitor factor exposures. If you think about idiosyncratic risk, that's really stock by stock. It's not some characteristic that's broad across the universe. And so when you have asset managers who choose stocks where we can identify the risk as primarily idiosyncratic, that provides better diversification. Mm-hmm. Factors can rotate quite cyclically, mm-hmm. and so idiosyncratic risk provides better diversification.
And Andrew, kind of going back to you, how does this play into fund construction, manager selection, these different types of risks that Frank just highlighted?
Of course. I can start with manager selection first. As we're evaluating either prospective or current managers, we want to make sure that our managers are taking on more idiosyncratic risk than factor risk. We want to make sure that the excess return that they're generating is coming from stock picking rather than factor exposure. In the markets, you can get factor exposure extremely cheap, and we want to make sure that we're not paying active management fees for factor exposure. So that's how we're looking at it from a manager standpoint. From a fund construction standpoint, we want our funds to lean towards that stock-specific or idiosyncratic risk and away from the factor risk. We want to make sure that no one factor or large bet is going to drive the risk and return of our funds. And in doing so, we're actually reducing the risk profile of our funds and allowing our best-in-class active managers to generate returns through their stock picking.
Yeah, thanks for the update. And our viewers have heard a lot about changes to the equity funds. We had some changes to our U.S. equity fund. What updates should our investors expect as it relates to our equity offerings?
Of course. We've done a lot of work in 2025 on U.S. equity fund that we've discussed a little bit today and in previous webinars. Additionally, we want to make sure that we're creating greater flexibility and choice for our client base. And in doing so, we plan to offer additional options, additional equity offerings in 2026 for our investors, starting first on the domestic side and then moving towards the international side. I think the second update that's worth sharing is we've been doing a lot of work on international equity fund. In 2025, we launched International Equity Index Fund, which serves as the passive component for IEF. We changed the benchmark to the ACWI ex-US at the end of 2025. And the team and myself are currently meeting with managers, fleshing out our conviction in active managers, and thinking about how we want to allocate the broader fund.
Great. Well, thanks for the update, and thanks, Frank, for your update as well. And always love sharing your knowledge and your expertise with our viewers. And thank you all for tuning in.